Forget getting lost in endless charts. Fundamental analysis is where the real power lies. It's about seeing the big picture, a country's economic health, from GDP to central bank tweets. Ever wonder why the Aussie dollar might skyrocket when China faces a hiccup? That's the magic of fundamentals in action. Have you ever felt like you're throwing darts at a Forex chart while blindfolded? I've been there too, until I discovered the power of fundamental analysis. It's like switching on night vision goggles in a pitch black room. Suddenly, you see the secret sauce that sets the pros apart from the rest. In this video, I will explain what is fundamental analysis, discuss how macroeconomic factors such as gross domestic product, interest and inflation rates, employment data, political and geopolitical events affects Forex market. What is fundamental analysis? Fundamental analysis looks at economic, political, and financial factors that influence currency values. It is the reason behind price movements and movements. For example, if the US Federal Reserve announces an interest rate hike, the US dollar typically strengthens. Why? Because higher interest rates attract foreign investors looking for better returns. That's fundamental analysis in action. Key economic indicators. If you're serious about trading, you need to have an eye on key economic indicators. These are like the heartbeat of an economy, telling you if a country's currency is likely to strengthen or weaken gross domestic product. First up, we have gross domestic product, or GDP. It's basically the country's economic report card. Is the economy growing, shrinking? A strong GDP usually means a strong currency. Interest rates. Then there's interest rates. Central banks like the Federal Reserve or the European Central Bank set these rates. Higher rates attract investors, boosting the currency. Think of it like a savings account. Higher interest, more people want to deposit. Inflation rate, or rising prices, equals interest rate hikes. A rise in interest rate makes currency exchange rate to be bullish. Employment data. Next, we have employment data, specifically the non-farm payrolls, NFP, in the US. This report shows how many jobs were created or lost. A strong NFP, boom, currency goes up. A weak one, not so much. Real-life example, European Central Bank ECB rate cut drama. Let's rewind to when the ECB slashed rates. What happened? Euro yields dropped, investors fled to USD. Sentiment, fear spiked, traders bought safe dollars. Data, weak European Union GDP confirmed the downturn. Result, Euro-US dollar nosedived. Boom. Fundamentals in action. Political stability. This is huge. If a country's government is shaky, investors get nervous and the currency takes a hit. Remember Brexit? Or any major election. Those events caused massive volatility geopolitical. And then there are geopolitical events, trade disputes, wars, anything that creates uncertainty. These can send shockwaves through the market. Brexit, pandemics, these events are market grenades. Remember COVID? Currencies went wild. Safe havens like Japanese yen soared while riskier ones tanked. Market sentiment. It's basically the overall mood of traders. Are they optimistic? Pessimistic? This can have a huge impact. You can gauge sentiment through things like consumer confidence surveys or business sentiment indexes. A strong non-farm payroll report may push the US dollar higher, but if inflation is also high, traders may anticipate a rate hike and push it even higher. Combining fundamental and technical analysis. Think about it. You see a beautiful uptrend on your chart, but then a surprise interest rate hike comes out, and bam, your trade goes south. That's why you need to marry these two approaches. Let's look at a real-world example. Imagine there's a major news release, like the US non-farm payrolls. The numbers are much stronger than expected. You know this is bullish for the USD thanks to your fundamental analysis. But instead of jumping in right away, you wait for a technical confirmation. You see a breakout above a key resistance level on your USD CAD chart. That's your signal. You enter a long trade, confident that both fundamentals and technicals are aligned. Your fundamental analysis toolkit, ready to start? Arm yourself with economic calendars. Forexfactory.com is my jam. News feeds, Bloomberg, Reuters get real-time alerts. Central bank schedules, mark those meeting dates. Common mistakes to avoid. Now, before we wrap up, let's talk about some common pitfalls traders make with fundamental analysis. Ignoring the bigger picture. A single news event is not the whole story. Look at the trend over time. Trading the news without a plan. Just because non-farm payroll is strong doesn't mean you should blindly buy US dollar. Wait for confirmation. Overreacting to market noise. Not all news is impactful. Learn to separate high-impact news from market noise. All right, traders, that's fundamental analysis in a nutshell. It's about understanding the story behind the charts. It's about being an informed trader. Let me know in the comments below. And if you found this video helpful, give it a thumbs up